Let's start the question number 3, right? This is actually based on the pre-seen 2024 December, but actually I have prepared this question focusing this coming exam, right? But some data I have connected in data wise with the December pre-seen, but I wanted to focus on the coming exam, right? Okay, chairman made a special comment at very first board meeting and mentioned that the coming year is going to be turning point for ELP as they committed to take the company to the next level and requested the senior management to actively engage in a series of meetings arranged to take this matter forward. Given below are highlights extracted from the meeting minutes, right? Meeting number 1, shareholder meeting. Following a series of discussions with the board of directors and the shareholders, the chairman has decided to proceed with the acquisition of OSL as part of ELP strategic expansion plan. After consultation with company auditors, ELP has decided to adopt discounted cash flow and asset-based valuation approach to determine a price range for negotiations. This is very important, right? You are decided to have a price range for negotiations, right? You plan to use DCF method and asset-based valuation. Through that, you are trying to have a price range. Please consider following information as essential for your valuation analysis. Revenue and operational profit projections. Revenue and operating profit are expected to grow at an annual rate of 5% in line with inflation for the next 3 years. From the 4th year onward, the entity cash flows are expected to grow at a stable rate of 3% in perpetuity. Adjustments to financial statements. Fixed assets are believed to be overstated by 8%. Inventory and debtors are overstated by 4% and 5% respectively. The book value of equity and debt, including both current and non-current portion of interest-bearing loans and borrowings, is assumed to be reflected market value. Additional assumptions. Income tax rate 30%, depreciation amortization 50 million per annum for the next 5 years, starting from 24/5. Other income and finance income will also be adjusted in line with the inflation. Working capital requirements are expected to increase at a rate of 3% per annum. The weighted average cost of capital for combined entities is estimated at 15%, aligned with WACC of the individual entity pre-acquisition. The weighted average cost of capital for the combined entity is estimated at 15%, aligned with WACC of the individual entities pre-acquisition. Expected capital expenditure of OSL are also estimated as follows. Then there is a mean 2, right? Let's read the question. Point raising at meeting 1. Recommend a price range to offer OSL shareholder for his total equity share and comment on the applicable each computed value per share. The number that JV option discussed in meeting 2 due to negative NPV reported. That is that second meeting, right? Let's keep aside. Now we can go for the first one. We have to recommend a price range and comment on the valuation model used, right? Okay, they have decided to use the discounted cash flow method and asset-based valuation. Let's start with asset-based valuation. Going back to the pre-scene, right? This is Ocean Shipping Line balance sheet. Property, plant and equipment, capital work in progress, investment in associate, financial asset, deferred income tax, then current assets, equity, non-current liabilities, and current liabilities, right? In asset-based valuation, what we have to do, we have to take their net asset and make necessary adjustment for assets and liabilities. Simply, it's called revaluation. You have to revalue assets and liabilities before make the asset-based valuation, right? Okay, let's take this question 3, right? A asset-based valuation, right? Net asset of the company. Take from here. OSL balance sheet says their net assets 625 million, right? You can see here 625 million. Yeah. Now all the adjustment for assets and liabilities we have to make to the net assets. That's a simple approach, right? Here, these information given for the discounted cash flow valuation model. These information you can use. Number 1, fixed asset are believed to be overstated by 8%, right? That means you need to reduce it by 8%. Believed to be overstated by 8%. Fixed asset, right? Going back to fixed assets. Now there are fixed asset, property, plant and equipment, capital work in progress, right? These are investments. Therefore, you have to take these two. In 213 capital work in progress, therefore you can't take it. You can take only 5,200. They mention that it believed to be overstated by 8%, right? Here. Then you can make the adjustments for that. We take only 5,200 because other one is capital work in progress. Now they said that this has been overstated by 8%, right? If it is overstated by 8%, now here you have 808, not 100. If there is 100, right? Overstated by 8% means it will increase by another 8 and ended with 108. Therefore, this 5,200 equal to 108, right? What you have to do, you have to divide this by 108 and multiply it by 8, right? It should be a minus number. Better if I can talk to you. Let's see whether they can allow you to talk to me. Aruna, Strano, can you allow students to talk to me? Since we
Yes, yes, they can speak. They can speak.
Right, good, good. Sean? Priyanta?
Yes, sir.
Is it clear? This
Yeah,
calculation?
it's very clear. Yes, yes.
Right. Right. Better you can talk to me. If anything you want to clarify, please talk to me, right? Okay. Then inventory and debtors are overstated by 4 and 5% respectively, right? Now, inventory and debtors you can take here. I will explain it later on. Inventory and debtors. Inventory 711, debtors 1325. 711 and 1325. 711 1325. Am I correct? Yeah. Now somebody can argue this overstatement, no need to divide by 100. Let's just calculate at 8%, right? In such a case, you don't need to multiply it by 110, 108, right? Just take only 8%, right? Like this. You can take like this. If you want to take like this, you have to write down the assumption. Keep in your mind, you have to write down the assumption. We assume on the given balance sheet value, this percentage need to be reduced. That assumption has to be there. Is that clear, Priyant? If I'm not going to divide by 108, you just going to take 8%. Write down the assumption, right? It assumed 8% overstatement is equal to 8% on the balance sheet value. Then you can just use the percentage. But if you want to use it, you have to write down the assumption, right? Priyanta, is that okay?
Yes, yes, this is clear.
Inventory 4 and debtors 5%, right? Going back to the question, the book value of equity and debt is assumed to be reflected market value. That's okay. Then another information, this we have taken already, done, right? Income tax, depreciation, other income fine will also adjusted, working capital, that's all, right? Those are the only adjustments you have to make, right? Now you can take adjusted net assets. This is the adjusted net assets of the company, right? Net asset value of SCL, right? Sorry. Now in exam, they may provide more information about other line items also. This has increased, this has decreased likewise. Lot of information they will give you. What you need to do all the adjustments to the net asset and take the net asset value, adjusted net asset value, right? Adjusted net asset value. Okay, let's move into the discounted cash flow method of valuation, right? Now in this case, they explain the revenue and operating profit. We don't want to take revenue because we can start our projections because we need the cash flows, right? Since we need the cash flows, better we start from operating profit, right? Don't take revenue, then you need to do more calculations to arrive the operating profit. Therefore, directly you can start from the operating profit. I expected to grow at an annual value at an annual rate of 5% in line with the inflation for next 3 years. Therefore, let's take 3 years here, right? Years, 3 years. Operational profit you can take here. Now it assume that it will increase by 5% per annum, right? Here they gave you the current P&L. As per the current P&L, earning from operations before depreciation, right? They gave you before depreciation, that is more than enough because no need to add back depreciation, right? No need to take the depreciation because it is not a operational, sorry, cash outflow. Therefore, let's take earning from operations before depreciation 2077. Multiplied by 0.5% per annum, right? It should be 1. Right. Then next year also increased by 5%. Right, like this it will increase.
So we take company value.
Sorry,
We are taking the group valuation or company.
no, here this is based on the pre-scene of December Puta, this is December pre-scene, right?
Yeah, this is 2, no sir. 23.
This is 24-23 P&L.
Correct. Yes. Sorry.
This is a single company, Puta. Clear?
Correct. Yes.
There is no group to going to acquire. Okay.
Okay.
Right. Then let's take the balance information. Thereafter, their cash flows, free cash flows will increase by 3% perpetually. That is for the terminal value calculation, right? Let's take it later on, the terminal value calculation, right? The book value and of equity and debt is assumed to be reflected market value. Additional assumptions, income tax 30%, depreciation and amortization 50 million per annum for the next 5 years, right? Other income and finance income will also be adjusted in line with inflation. Working capital requirements are expected to increase at a rate of 3% per annum, right? Now, depreciation, since we have moved out from the depreciation, right? You can remove that. You know, you already considered not to take it to add back. Other income and finance income. Let's go to that point. Now, if you take this P&L, they have other income 472 and finance income tax, other income, administration, earning, dividend, profit from operation, finance cost, share of profit from associate, right? Then other income we already considered here. What they said, finance, other income and finance income will also be adjusted in line with the inflation. Here we take other income also 5%. Since we have taken 2077, it automatically calculated for 5%. No need to consider again, right? Here, in here, no finance income, but the theory keep in your mind, write down if you want, right? When we do the valuations, when we calculate free cash flows to equity, sorry, free cash flows to firm, you are not consider finance income. In some time you are not consider, in some time you will consider, right? This you have to clarify. Some people add finance income to cash flow and calculate the free cash flows to the firm and get the enterprise value. If you include cash flows in the finance income cash flows into the cash flow calculation, you don't want to add back financial asset when you add back in cash to the enterprise value. Priyanta,
Yes, sir.
I think you can remember when you calculating, you know how to get enterprise value, right? Priyanta?
Sorry, sir, I followed. Yes, sir. Yes, sir.
When you get the enterprise value, after you get the enterprise value, that means when you discount free cash flows to firm, you get the present value, we call enterprise value. Is that clear, Priyanta?
Yeah, it's clear.
Then you will reduce market value of debt from that, correct?
Correct, yes.
Then you will add back cash balance to that.
Okay.
Correct.
Yes,
You
it's
will add back
yeah.
cash balance to that. Some
Yes, sir.
people add back financial asset also to that. If you want to add back financial asset to that, you can't take cash flows from finance income into the cash flow
Right.
calculation, right?
Yeah, that
Either
part we have
cash
to remove.
flow, either value. Only one you have to consider, right?
Okay, okay. That's
Is that
okay.
clear, Priyanta?
Yeah, that's clear. Yes.
Right. Hanifa,
Yes, sir.
are you okay with that? Is that clear?
Yeah,
What I
yeah.
have explained?
Yes, sir. Yeah, I'm clear,
Right.
sir.
Bhagya,
Yes, sir.
okay. Now here no finance income, therefore we can ignore. If you consider finance income as a cash flow, don't add back financial asset with the cash. If you have not considered, right, you have to add back financial asset. Now here, the other thing is they have profit share from associate. Clear? Profit share from associate. Now profit share from associate, no information given. What you can do, without considering profit share from associate to cash flows, you can take that associate value into the enterprise value, right? The simple theory is if you consider cash flow, don't add back anything when you get the value from enterprise value. If you have not considered cash flow, you need to consider those assets into the calculation, right? Since it is not clear in share of profit from associate, right? Ignore the cash flow. Let's take that asset value into the calculation at the end, right? Keep in your mind. Working capital requirement are expected to increase at a rate of 3%, right? Now, from what? From the given balance sheet. If you take this balance sheet, right, let's take the working capital requirement. This is inventory and trade and other receivables and cash. Let's copy and paste here. I will do workings here, right? Working capital. Okay. Year 0 is today, given balance sheet. Then year 1, year 2, year 3. How much we have inventory, debtors, and cash. And we have to take payables. Let's take it from the balance sheet. 7111325. 7111325. Cash balance 1602. Then the payable balance, trade payable, you have 1401. Right? Now this is the total working capital requirement today. This is the today's working capital requirement. This will increase by 5% per annum, right? That means this will increase by like this every year. This will
Excuse me,
increase.
sir.
Yes.
Do we need to add the cash also for the working capital? Normally, we are taking debtors, inventory, and payables, no? For working capital calculation, do we need to add the case also? Because we are adding
That
case at
depends
the end
now.
of.
For an example, right? Now working capital, when you make the right, this is depends, Putana, right? Now working capital requirement means how much you need cash to run the business, right? When you have cash, that cash not enough to run the next year business. Therefore, generally you have to take all four. But we have practiced over a period, we are only gets other than cash. That's why you have a problem here. What's your name, Buddha?
Hanifa, sir.
Hanifa. Right?
Yes.
You can take it or you can delete this. That's not a problem. But the thing is, generally the working capital is inventory data and cash, what we have, and the payables. Some people take tax payable. Some people takes the other payables you have. For an example, if you take this balance sheet, that's depend, write down your assumption, right? Now, working capital requirements, how much cash I need to run the next year, right? Now here you have trade payable, you have short-term balance payable, statutory payable. This is a part of working capital. Accrued expenses, also part of working capital, but generally as a practice, we ignore it. We ignore because we assume those are not continuously happen, right? Then why you ignore cash? We believe cash balance is not stable every year. Some year you have OD, some year you have plus balance. Now here you have 1 billion cash in hand at the end of the current financial year. That's why they are ignore it and consider only these three. Is that clear, Hanifa?
Yes, sir.
If you take only these three, you have to write down an assumption here. Assumed, right, that only above items operates in working capital. Likewise, you have to put a assumption, right, Hanifa?
Yes, sir. Understood. Yes, sir.
Okay, now every year it will increase by 5%. I think I have correctly put the assumption, right? Now you have to take the difference. Investment is the difference between 2 years, right? Like this. This is the working capital investment. Therefore, you can put here working capital requirement as a minus answer. This is working capital. This is working capital. This working capital investment. Right? Going back to the question, the working capital is done. Then CapEx, you have to consider as outflow 5, 10, and 15 for next 3 years. CapEx minus 5, minus 10, and minus 15. Right? Now we don't want to add back depreciation since we have not gathered that depreciation number. We got the operating profit before depreciation, right? Then we deducted CapEx, right? We consider working capital. Now only thing you need to consider is the income tax, right? Tax. Here they mention that Your tax rate is 13%, right? Income tax rate is 13%. Now 30%. Now you have to calculate income tax at 30%, right? Let's go to the income tax calculation now. When you calculate income tax, you have to carefully take the tax computation theories for this. Here they given you the PNL, right? Now current operating profit 1.9, right? 1.9 billion. The finance cost is there. Share of profit from associate 40. Profit before tax. This is income tax, right? Now you should have a method to calculate the income tax. Now to calculate the income tax, you must be able to estimate taxable profit for next 3 years. Is that clear, Priyantha? Priyantha? Hanifa?
Yes, yes, sir. It's clear, sir.
Right? Here I have a message. Let's see what is it. Working capital, I said that 3% here. Somebody asked what is working capital requirement increased by 3%. I mistakenly I may put 5% here. Sorry, I will correct it. Mistakenly I have put 5%. Now that's correct. Thank you. Right. Thank you. I have corrected it because I mistakenly put 5% since I have continuously used 5% here. Now to calculate the income tax, you need taxable profit for all the 3 years. Right. Now what you can do? One, you can take the current PNL and using the assumptions given that revenue increased by 5% also, operational profit also increased by the same rate. They gave you the information. Assuming other information remain constant, right? Or going with the same increase line, you can estimate accounting profit. Clear? In this PNL, the current accounting profit, income tax expense here, 254. Assuming same pattern that 5% increase take place, you can assume next 3 year profit before tax, right? Then you can add back depreciation, deduct capital allowances, and charge the rate. That's the way, right? But if you see here, 254 into 30% is the 72, right? In accounting profit, they have directly calculated. Now you have to make an assumption here. Let's take profit before tax, 254, right? Profit before tax, 254. Oh, not today. For the not year one, for the current situation, 254, right? We can assume this will increase by same pattern of revenue and operating profit 5%. Is that clear, Hanifa?
Yes, sir. But they mentioned that depreciation and amortizations are 50 million. So
Yeah. Now I will take
don't we
when we make the adjustments, right? I will take those
Okay.
things when we making adjustment. Now we have estimated like this, the profit before tax, right? Or you can take effective tax rate. The effective tax rate is profit before tax and the income tax expense. Any assumption you can put here. Here you have to write down, assume that the sales increase and operational increase of 5% will implement for the profit before tax as well. That is the assumption you have to make. Right? Now you need to add back. You already know, we already in this profit before tax depreciation deducted. Therefore, you have to add depreciation. That is 50 million every year as per the assumption. Is that clear? Hanifa, you wanted to know this one, right? Hanifa?
Yes, sir. But I'm confused. Don't we need to add back the depreciation and calculate the 50% increase for next 3 years for the profit? I mean, from
That means
54, I mean,
take this
2020,
without
yeah.
depreciation and consider that.
Yeah.
Yeah. Now your problem will sorted out. Listen to me. Now this question silent about capital allowances, Hanifa. Clear? This question silent about capital allowances, right? Got it? Hanifa?
Yes, sir.
Now for tax calculation, you need depreciation as well as capital allowances, right?
Yes.
Then what you need to do, you have to assume depreciation and capital allowances are equal. Got it? Then you don't want
Yes, sir.
to make any adjustments. Clear? You don't want to make any adjustment on that because depreciation and capital allowances are equal.
Excuse me, sir.
That's the assumption you have to make when the examiner silent about capital allowances. Yes, talk with her. Any question you can ask.
Sir, when calculate P-class for the perm, when calculating a tax payment, no need to consider interest expense.
No, don't mix. Understand this financial management and taxation. When you calculate the tax, you have to do the calculation of taxation as per the tax laws, Puta. Clear?
Yes, sir. Then P-class for the perm entitle all debtors, debt holder and equity. Therefore, no need to consider interest expense deducted from EBIT when considering the
Puta,
tax
that is
payment.
for cash flow calculation. For the cash flow calculation, you don't want to deduct any finance expenses, right? But you have to calculate the tax outflow. How much cash outflow because of the tax? How much the cash you paid for the Inland Revenue Department? Is that clear?
Yes. Then, sir, if in this question, when we decide when we not calculated from profit before tax in the question in pre-scene from the this forecasted profit operating profit and calculated, we need to again deducted interest expenses, no?
Yeah. Now that's why I have taken profit before tax here. This is already deducted for interest.
Yes.
Clear?
If I not consider this profit before tax, if consider this operating profit, need to deduct interest expense, no? If normally other question, if start from EBIT, we need to deduct interest expense when calculating the tax payment. In other questions, if I calculated cash flow starting from EBIT for a tax payment, we need to deduct interest expenses for a taxable income. Clear?
Yeah, when you have to see very simple, Puta. When you do the tax computation, do the tax computation as per the tax law, right?
Yeah. Okay.
It is not a financial management. It is not CFRA.
Yes.
Right. Now here, no information about capital allowances. Therefore, we assume depreciation and capital allowances are equal, right?
So one doubt.
Yes.
So in 254 profit before tax, they have already deducted depreciation 177. If we deducted 50 million, the depreciation again, that will be duplicate.
No, now no need to do anything because we assume income tax rate, sorry, depreciation and capital allowances are equal, Buddha. Clear?
No, so I mean that value in 2024 they have
Yeah,
deducted
there is a reduction
177.
of, yeah. What
Yes,
you
but in
can
the
do, you
question,
need, yeah, you mentioned that, Buddha, I know, right? Here, they have charged depreciation 177,
yes,
right?
sir.
That's the issue you have. Now here,
Yes,
we have taken 254, right? After deducting 177, you want to add 177 here, right?
and minus
And
50.
minus 50, right? This is you need. Got
Yes,
it?
sir. Yes.
All right, you can do that. That's okay. It is not a big problem to them. Here, at the examiner in financial management, they just focus on the valuation technique what you have applied, not the 100% accuracy of the tax computation, right? You can make an assumption and do the tax computation.
Yes, sure.
But your question was this, right?
Yes, sir. Yes.
Right. Then, okay, now depreciation and capital allowance is equal, then you can assume this is the tax, right? Now you have cash flows.
Sir, in this case, we have to again deduct the. You already deduct the depreciation, right? Okay. Okay, sir. Thank you.
Right. Now put the terminal value, right, at the third year. Third year terminal value, they said the third year cash flow will increase annually at 3% growth rate up to perpetuity, right? And for the ease of calculation here, WACC has been given 15%, right? Therefore, no need to calculate that. The weighted average cost of capital for the combined entity is estimated 15, aligned with WACC of the individual entities pre-acquisition. Therefore, no need to do the WACC calculation here. But in the coming exam, you have to do the WACC calculation, right? Keep it your mind. You have to do the WACC calculation. They have given all the information for that. Without that, they have not given finance cost rate. That's the only information they have not given. All other information are given, right? Okay, let's do the terminal value. You know the formula for terminal value, right? The cash flow, you will multiply it by 1 plus G. G is 0.03, right? Then entire value you will divide by WACC minus G, right? This is divided by WACC is 0.15 minus G is 0.05. Therefore, terminal value will be this much. Is that clear? You want to write down the formula? Cash
Sir,
flow
G-
into 1
G
plus
is
G
3+, sir.
divided by, sorry?
That was
Here.
03.
Yeah. Now you can take free cash flows to firm. Then discounting factor 1 divided by 1 plus 1.15. Is divided by 1.15 like this. Then present value. Then total of this called enterprise value. Right? Enterprise value is the sum of these three. Then you have to reduce value of debt, market value of debt. They ask us to assume it equal to the book value. Therefore, go to the balance sheet and see how much the debt value. Current portion of the debt is how much? 1677. Current portion 1677. Non-current portion 5500. Right? 5500. 1677. This is the total debt value, right? Then you need to add back cash. We have not considered finance income, therefore financial assets. You have to add, and we have not considered associate cash flows also. Therefore, investment in associates also you need to consider here. Either cash flow, either asset, whatever you need to consider. Only one out of two, right? Going back to here, cash balance is yes.
So if we take that cash
Yes.
balance into the working capital calculation, we need to again put here?
Yeah,
Cash
working capital is just to calculate the investment in working capital, Puta. Right?
So one of the past papers I saw that they have said that they have assumed the cash is totally used for the working capital purpose, and they had not taken into this enterprise value calculation.
If you take cash flow here, no need to take here. Now I have removed here, Puta.
Okay, sir. Okay, sir.
Right? Then your financial asset 56, associate.
Sir, financial asset, we
430.
consider the finance income, no?
We have not considered finance income, Puta. We consider other income. In cash flow, we have not considered finance income.
Okay, sir.
Financial asset, we have 56 plus 323, right? I think I'm correct. 323, yeah. Then associate for 32. Yes.
So
Tell
this
me.
investment in associate value, we need to take it as fair value or market value or like that something?
We need, but examiner not given. If examiner given it, better take the market value of the shares.
Okay, sir.
Take the best option is I will write down. Best option is to take market value of shares. Correct?
Okay, sir. Thanks.
Right. Now this is the value of equity. Now you can negotiate a price between very small price of 114 to 12,716. Right? Let's check that numbers again. And net assets, they have 625. Yes, that's correct. Right. Now you can say the company shall negotiate a price in 114 to 12 billion. Right. Now, the same question, they ask a question. Comment on the valuation method. Asset-based valuation. Right. Asset-based valuation always suitable to value highly asset incentive businesses or businesses without a going concern. Basically, when you are going to buy a company, the best option is to value the based on cash flow. Because you will buy a company's future ability of generating cash flow. Right? Therefore, asset-based valuation, This is more suitable. Let's write down more suitable for a valuation of mostly assets in the incentive businesses. Right, like real estate companies, likewise, right? When you have more real estate assets in your balance sheet, you are earning rental, better sell off the company based on the asset market value, not based on the present value of rental income. Right? More suitable for a valuation of mostly asset incentive businesses. This method is used in non-operating businesses or business does not have going concern. Then you can value the assets and by the company. Say there is a company, no operations, but they have assets. Then you can value the assets and buy the company, right? There is no going concern, therefore you will value the assets and buy the company. At the time, mostly asset-based companies you can buy using the asset valuation method. Discounted cash flow valuation method, right? When selling or acquiring a company having future earning potentials. DCF method is more suitable. However, accuracy of assumptions and estimations directly influence the accuracy of the value of this. The accuracy of the directly influence the business value. Hanifa, is that clear?
Yes, sir.
Excuse me, sir. Hello.
Okay. Now we can go Q3B. Yes. Yes, Puta.
So since there's the inflation, don't we need to adjust it to the discount rate?
We need to do it if we wanted to calculate it quickly. In this question, for the ease of calculation, they have given it. Clear?
Okay, sir. Thank you.
Keep in your mind, Puta, when you adjusted the inflation for the cash flows, you want nominal WACC. If you have not adjusted the inflation, you need the real WACC. If that is the case, it will be a 40-50 marks question itself. Clear?
Okay, sir. Clear.
Okay, quickly moving into the second meeting, right? This is the question I want to emphasize this time. I believe there can be some project appraisal question in question number 3 or definitely in question number 2. you will have a project appraisal, right? Definitely you will have a project appraisal question. My doubt whether it is in question number 3 or 2. If it is in the question number 2, it's a separate independent question. But if it is in question number 3, definitely connected to the pre-C. Therefore, this question has been included, assuming this given pre-scene, but actually this connected to last year pre-scene. But I assume, right, impliedly try to tell you there may be a project appraisal question in question number 3 like this. Okay, that's why I took some information here to connect with that. Okay, board meeting 2. Further, chairman put forward JV arrangement with the Maldivian Leading Education Institute, MAL, where both parties, ELP and MAL, would participate in equity capital and incorporate a new degree awarding institute in Maldives as CB Maldives Academy, right? Each party would introduce 40% of total investment value, and the balance will be introduced by ELP as an interest-free loan payable in 5 years. Total investment value has been calculated at MVR, that is Maldivian rupiah, 200 million. ELP would transfer net asset together with employee at an agreed price of 80 million, because this is a 50-50 joint venture. You have to put 80 million there, they put 80 million, balance is a loan as its capital, which is 40%. Both parties would be entitled to withdraw free cash flows at the end of each year equally for the first 5 years. And thereafter, ELP will be entitled to only 40% of free cash flows. CBMA will remit money to Sri Lanka at the end of each year. The loan from ELP will be financed by liquidating a portion of ELP's short-term investments. ELP estimated ELP's investment policy is to add 5% company's weighted average cost of capital to reflect risk involved in cross-border investment. When you make a investment in foreign country, you will consider it is a risky comparing to doing business within the same country, right, within Sri Lanka, right? Therefore, they will add 5% on the normal weighted average cost of capital to identify the specific risk in outside the country. Assume free cash flows reported for year 5 will continue into future, at least same level, but Sri Lanka rupee equivalent free cash flows that is received by ELP will be grow by 5% each year, starting year 6 due to depreciation in rupee against MVR. The project appraisal of CBMA has been prepared by ELP's assistant accountant and is given below, right? It's given in Maldivian rupees, earning before interest and tax, less income tax, net operating cash flows, less changes in net working capital, loan repayment to CBC, right? Free cash flows to equity, investment on terminal value, discount factor at 13%, net present value. Terminal value calculation is given. Note number 2, exchange rate also given, right? Due to delaying of construction and inability of commence operation as planned, the original proposal bank offer loan Torian on the repayment will begins 24-25. The summary of moratorium offers as follows. Bank will accept the capital repayment over 3 years commencing from 26-27. ELP shall reduce interest for during 24-25, 25-26, where no capital repayment will occur. Those are additional information, right? The board of directors has rejected the JV option discussed at meeting 2 due to negative NPV reported at project level. Chairman is still in favor of the project on the basis that JV would be a better strategy to establish foreign operations. Analyze the project appraisal by the assistant accountant and explain it would be risky to go ahead based on the numerical calculation by mentioning 3 qualitative factors that would prove the decision to be wrong. Evaluate the impact on ELP SWAC if company accept loan moratorium offered by the bank? That's the other question, right? Okay. Now, analyze the project appraisal prepared by the assistant accountant and explain it would be risky to go into the numerical calculation. Now, we have to do this from our company's perspective. Actually, this is the project appraisal report prepared for Maldivian project. This is not our project. We only invest 40% here. Now we have to do the project appraisal based on our company. This is the full project appraisal, but this is a joint venture. Therefore, what we need to do, we are investing only 80 million Maldivian rupee, and we need to estimate what is our cash flow, right? What is our cash flow, and take it out from here and do a project appraisal only for our company, not for this project. This is entire project appraisal. We need to do a project appraisal for our portion. Is that clear?
Sir, we can't hear you.
Sariputta, I got disconnected. Priyanka, can you hear me now? Priyanka?
Yes, now we can hear you, sir.
Sorry, I was disconnected.
Yeah, now we can hear.
Okay. Now it's okay, sir.
Now here, what I have explained, this project appraisal, you can see my screen also, right?
Yes.
Right. This project appraisal has been prepared at the perspective of Maldivian project as an entire project. What we need to do, we need to see whether this project is worth or not for our company. In such a case, what we have to evaluate, how much we put and how much we get. Just compare those two only. Priyanka, correct? Got it?
Yeah, good. Yeah, that's it.
Right. Let's start that part. We have to go for a project appraisal table. It has 5 years, right? Years. 0, 1, 2, 3, 4, 5, right? Then we can take investment clearly mentioned, right? It is 80 million, right? This is in million, right? Values in million. We will use two currencies. Here 80 million Maldivian value. Here MVR Maldivian rupiah, right? Investment MVR 80 million is a minus value. Right? At the 5th year, we will come back to Sri Lanka from this project. Since this is a project, not an asset-based project, this is a business. We can't take residual value, we have to take terminal value. Therefore, keep in your mind, you have to do the terminal value at the 5th year and take here of our cash flows, terminal value of our cash flows, right? Let's take it later on. Let's put the investment now. Then our cash flows. Cash flows. Right? How question explain that? Both parties would entitle here. Both parties would entitle to withdraw free cash flows at the end of each year equally for the first 5 years. Thereafter, ELP will receive only 40%. Okay, now let's take the first part. Equally, they will distribute free cash flows in the first 5 years, right? Okay, here, earnings, interest tax payment, depreciation, net operating cash flows, changes in working capital, loan repayment, right? All are okay. Free cash flows to equity for the first year, 14.57 is the number. Is that correct, Ajit? Sorry, Priyanta? Priyanta?
Yeah. Something wrong with my signal. Now it's
Okay. Let's take free cash flows to the business. Free cash flows to the project. They're given as 14.57. 15.7. 16.59. 22.27. And 23.47. Right. This is the free cash flows to the business. We only get 50%, right? Company share, they will distribute equally in the first 5 years. Therefore, they will get 50% of this, right? This is the company share, right? Going back to the question, then they have calculated their terminology, not relevant to us. Now, what actually we get in the first 5 years, we will invest 80 million in Maldivian rupees as per the question here. $80 million Maldivian rupee, and we will get this. Therefore, our net cash flows will be, right, this plus this our line. Therefore, this is our
Sir,
net
excuse
cash.
me.
Yes.
Sir, this forecast prepared by assistant accountant, they deduct the loan repayment also, the
Yeah,
8 million.
we
That's
can
not correct, no?
divide it among ourselves, Puta, as the shareholder actually free cash flows to equity, right? You can't distribute, you and the other shareholder can't distribute the cash flows to the business without paying on the loan, right?
I'm not clear about
Very-
that. So normally in the cash flows, we don't consider the debts payment, no?
This how many times you sit for this subject with the
This is my second time, sir.
your Hanifa?
Yes.
Second time. Puta, you are actually in you misunderstood what is a project appraisal and what is a business valuation. Got it? In a business valuation, Puta, you will first value the business, then deduct the debt value and get the equity value. Is that clear?
Yes,
Hanifa?
sir. Yes.
In a business valuation, first you will value the business, then you will deduct the value of debt and get the remaining as the value of equity. That is a business valuation. This is a project appraisal. A project appraisal and business valuation is a totally different two things, right, Pudha? In a project appraisal, what we take, how much we, what is the outlay at the beginning of the project or throughout the project, and what is the inflow throughout the project, and we will discount and see whether it is NPV plus or minus. Got it, Hanifa?
Okay,
In this
sir.
question,
Then
it clearly mentioned both shareholders will share the free cash flows to come to the shareholders 50-50. Can you share cash flows without repayment the loan, Puta? You and someone go on and started a business in Maldives. You borrowed money as well. Now, without deducting the bank loan and interest, can you share all the cash and bring it to Sri Lanka without repay the loan? Hanifa?
yes, sir. Can't, sir. Sir, in that case, then we are investing another 40 million also, no, as a loan. So don't we take that as initial investment?
We will invest 80 million. They will invest 80 million. Balance is borrows from a Maldivian bank. That is not our point. We are not going to invest in there. We will borrow from a bank. Once we borrow from a bank, we have to repay the loan, right? Is that clear?
So the discounting means that we are already allowing the finance cost in that discounting mean. Then are we again need to serve?
The project appraisal in a project appraisal discounting means what? In project appraisal discount means we will see whether we will get future cash flows more than our capital, cost of capital. We will discount here these cash flows by our WACC. In a business valuation, we will discount business cash flows by business WACC. Got it? Now I think you assume we are going to discount these cash flows from this project WACC. We are not going to discount these project cash flows from project WACC. We will identify how much we have invested and how much we received, and we will discount by our cost of capital. Is this Varuni?
Yes, sir. It's like a dividend here, no, sir? Remittance.
Exactly. You have sent 80 million Maldives and you get 7, 7, 8, 11 in next 5 years. From where you have sent this 80 million, Varuni? From your balance sheet. Am I correct?
Yes, sir.
You have taken 80 million from the share capital and the debts from your balance sheet. You are liable to repay interest and dividend for your shareholders and lenders. Out of that money, you send Maldives and you get this money every year. Now you want to see whether I have any remaining amount once I repay by dividend and interest to my shareholders. That is the purpose of project appraisal. Is that clear?
Yes.
Hanifa?
Yes, sir.
From your balance sheet, you send 80 million to Maldives. Now you are liable to pay interest to lenders and dividend to your shareholders. Therefore, you must earn more than that interest and dividend. Correct, Hanifa?
Yes, sir.
Therefore, you have to use your WACC to discount these cash flows. Right. This is net cash flows from Maldivian rupees, right? Net cash flows from Maldivian rupees. Now you need to convert this into Sri Lankan rupees as per the exchange rate given. Here they have given exchange rates. Today is 12. Then these are the rate. Forex rate. Let's take Forex rate. Today is 12. 1 rupee equal Sri Lankan 12 rupees. 12.47. 12.47. 12.95. 13.45. 13.98 and 14.52. Right. Now,
Excuse,
net,
sir.
yes.
So this balance will be introduced by ELP as an interest-free loan. So then, do we need to take that to the cash flow, sir?
No.
Balance 20 million.
Wait a minute. No, you don't want to take this, Puta. When you give them a loan, you get an interest. You have given it as an interest-free loan, right? Even it's an interest-free loan, you know, here this project identified, right?
Yeah.
Your that loan repayment they have identified. It comes separately to you.
It is not the outflow from our side, sir.
No, that is a, don't mix this project investment and given a loan. Got it? I will give you 100 rupees to run a business, and I will give you another 100 as a loan. I can't mix this loan and that investment. Is it two things? Is that clear?
Yes, yes, sir. Yes, thank you.
Okay, these are the net cash flows. Now you have to calculate the terminal value. Right, that question mentioned here. CBMA will remit money to Sri Lanka at the end of each year. ELP investment policies to 5% company or assume why will continue for assume free cash flows reported for year 5 will continue into future at the same level, but Sri Lanka rupee equivalent free cash flows that is received by ELPs will grow by 5% each year, starting from 6 year onward, right? That means there is no growth for this Maldivian rupee cash flow from the 5th year onward, but Sri Lankan rupee cash flow, there is a increase because of the depreciation. Therefore, you have to calculate the terminal value using, right, the WACC of your business, Now you need to calculate WACC of your business. That's the next duty, right? Now WACC is given in the above example as 15%, we can use it. But that 15%, you need to add another 5% because this is a cross-border investment. Is that clear, Hanifa?
Yes, sir.
Therefore, you have to use WACC as 20%. Right? Let's take the cash flow multiplied by 1 plus growth rate 5%. Right? This is the numerator of this equation. Then divide by WACC is 20% minus growth rate 5%. Is that clear, Varuni?
Yes, sir.
Is that clear why I have taken 20%? Because of the cross-border investment, you have to add additional risk premium on your WACC. Clear?
So it is 20 or 18. The
WACC was 15 in the previous equation, right?
But this 13% is for the Maldivian perspective, no? They have the assistant accountant.
That is not relevant to us. That is as a project in Maldives. Got it?
Oh, yes, sir. Okay, okay. Thank you.
That actually I have included this question not to learn how to do the project appraisal, to learn the rationale of the project appraisal, Puta. Got it, Hanifa? That assistant
yes,
accountant do
Thank
the
you.
project appraisal of Maldivian project. As a Maldivian project is a separate business. In this business, they have 13% WACC. Yes, absolutely. It may be 13% because they are getting interest-free loan. But now we are evaluating this business, right? From the perspective of Sri Lankan business. Got it, Hanifa?
Yes, sir. Understood.
Those are the actual
So this
points I want.
20%
Yes.
multiplied by 1.5, 105% or can we
No, you have
explain
to
that?
add 5%. You have to add 5% premium. That's all.
Okay, so that, no, on the one of the past paper, I saw that lesser they have multiplied the risk-free plus risk
No,
premium.
how they explain it? Increase by 5%, increase by 5%. To how they explain in the sentence is important. Here, ELP investment policy is to add 5%. Got it?
Okay, sir.
You know, this is the total cash flows in Sri Lankan rupee, LKR, right? Now discounting factor, 20%, 1 divided by 1.2, right? Divide by 1.2. And % value.
A0 should 1, sir.
Sorry. Yes, sorry. While the discussion, what I have actually realized, Puta, a lot of students in lack of principles of this project appraisal and business valuation, right? That is the thing you need to really understand. You always believe as a format you are doing it. That's why you always misunderstand that project valuation concepts and business valuation concepts. Actually, through this question, I wanted to tell you that's the examiner comments also clearly mentioned that student not able to do project appraisals very well. because you are only practicing business valuation and you think whatever it comes, that format you will use. That is the issue. You have to come out from that. Okay, now NPV become minus. Therefore, you can say it can be recommend not to go ahead with this investment. What are the other factors, right? Qualitative factors. Number one, accuracy of 5% premium added on company WACC to justify the cross-border investment. This is become minus since you have discount by 20%, honey. Why is that clear? If you have discounted this by, let's say, 15%, see what happened, right? It's become plus. Hanifa, can you see this?
Yes, sir. Understood.
Now, why it's become minus? Since you have added premium on the WACC to justify this is a cross-border investment, we are facing additional risk. But the problem is whether it is correct, right? Number two, the accuracy of forex rate estimated for next years. Those are the qualitative things, but there is a small correction I will explain you, right? You may not thought about that also. Here they have mentioned, here, look here, that Sri Lankan rupee equivalent free cash flows will grow by 5% each year starting year 6 due to depreciation of rupee against Maldivian rupee, right? Now it is starting from year 6. That means 5th year cash flow you have converted with 5th year forex rate. Now examiner here gave you 6th year forex rate, right? Here 6th year forex rate also he gave you. Why it has been given? That is the important point, right? That is 15.08. Why it has been given? That means there is a mistake we have done here. The terminal value calculation. First, you need to do that free cash flows in dollar, right? We estimated there is a constant increase in there is no increase in Maldivian cash flow. It will be constant. Remember, Priyanta, Hanifa?
Yes, sir.
Future at the same level. Year 5 will continue in the future at the same level. No increase in Maldivian rupees. That means year 6 also this will be the value. Got it? But exchange rate for the 6th year was 15.08. Right? That means Sri Lankan rupee value would be 177. Here we consider 170. That's the mistake we made. Therefore, here you have to take 177. Is that clear, Hanifa?
Yes, sir.
Varuni?
Can you explain it, sir, again?
Because they told in dollar Maldivian rupee term, there is no increase after 5th year in the cash flow. 6th year also it will be same. Got it?
Yes, sir.
Varuni?
Yes,
The
sir.
5th year cash flow will continue for a foreseeable future without any increase in Maldivian rupee. But when it's come to Sri Lankan rupee, it will increase by 5%. Right? Now, this is the 6th year exchange rate. Based on that, this will be the value, right? This will increase by 5% every year. That's why we calculated this and put 1.05. Varuni?
Okay, sir. 15.24, is it correct, sir? 15.08 or
That is the 6th year exchange rate.
14.52 multiplied by 1.05.
No, it is given in the question.
Okay,
So
sir.
after the 6th year, the ELP only receiving the 40% of the cash flow.
Yeah, that is
The
the other
question-
one we need to make adjustment. Now this
Yes.
is the this is 50% of the cash flow, right? We only get 40% of this. That means we need to multiply this 177 separately by 80%. Am I correct? Hanifa? Because this is 50%, we need to reduce only 10% from here.
Yes, sir.
Then when we take 80% is correct, right? Is that clear?
Sir, can you calculate the cash flow 6th year and get the terminal based on 6th year cash flow?
Yeah, you can do. No issue.
Okay.
The thing is, you are not getting entire 177. This is actually, this is the 50% of the cash flow. What you need to do, you have to take, this is 50%, right? Therefore, divide by 50% and multiply it by 40%.
Yes.
Got it? Divide by 50%, multiplied by 40%. Then it is 140, 142. Right? Then when it's 142, this is the 6th year cash flow. Then since you have considered 6th year cash flow, you can take here.
Sir, do we need to again add the G to that one since we have already considered the exchange rate?
Yeah.
there?
No need to, only one. That's correct, because we have considered already the increase. Oh, no. Sorry. We have to increase, Puta. Don't misunderstand. We are in two countries. In Maldivian thing, there is no increase. But when it's come to Sri Lanka, it will increase by 5% because of the Forex issue. Got it? Because of the Forex issue, we have to consider. Just see the difference between this is 5%, Puta. Multiplied by 1.05. No. This 5% increase comes, who raised the question, Puta? Is that Priyanta or Hanif?
Yeah.
One minute. Yes.
Sorry? Who raised the question?
I just asked you.
Yes, sir.
to
I
get
am
the
Hanifa.
6th year.
Yeah. This is the growth rate, not because of the cash flow growth, because of the foreign currency growth, Puta. The Sri Lankan rupee will depreciate against Maldivian rupee. Is that clear?
But anyhow, we have to apply the growth rate, no, sir?
Yeah, because of the foreign currency depreciation.
Yeah.
Right. Now, when examine asks about qualitative factors to consider, the first thing whether this correct, the application of 5% premium on WACC, then accuracy of forex rate estimation, right? Those are the major things you need to consider. In addition to that, you can write down, in addition to this investment, we are giving them interest-free loan of 40 million Maldivian rupee, right? The time value of money of this interest-free loan also to be considered as a qualitative factor, because we are not consider the loss we are incur because of this one, right? Time value, or you can say opportunity cost.
It's an opportunity cost, no, sir?
Opportunity cost of interest-free loan, right? You need to consider. These are the qualitative factors, right?
So if we took it, sir, discount factor is the our current WACC, no, sir?
Yeah.
Loss of
WACC of our company, right? Aruni?
Yes, sir. Are we no need to, sir, put here, sir, those cash flows?
Which cash flow?
Opportunity cost.
No. Here we asked to calculate only the project appraisal, not the loan. Loan is a separate business. Investment is a separate business. We evaluate only the worthiness of the investment we made, Varni. Clear?
Okay, sir. Okay, sir.
Now they ask another question. Evaluate the impact of ELP WACC if company accept the loan moratorium offered by the bank. Now we have a WACC, right? 15%. Keep in your mind. Now bank giving us a moratorium. Due to the delaying of construction and inability of commence operation as planned in the original proposal, bank offered loan moratorium on the repayment which will begins from 24/5. The summary of the moratorium as follows. Bank will accept the capital repayment over 3 years commencing from 26/7. That means after 2 years, we have to pay capital repayment, but you have to pay the interest. ELP shall pay reduced interest 4% during the first year and second year where no capital repayment will occur. Now, how it's affect to the WACC? You have to write down, right? When there is no capital repayment, what will happen? For first 2 years, debt value will remain constant. Therefore, no change in debt to equity ratio in the first 2 years. Is that clear, Varuni? Varuni?
Yes, sir.
Now, there is no capital repayment in first 2 years as per the moratorium. That means no change in debt to equity ratio in the first 2 years. Is that clear?
Sir, excuse me.
Yes, sir.
Due to retain earning, first to profit equity will change, no, sir?
Yeah, that will change. Now we are explaining the impact of this moratorium, Puta, right? Then we assume all other factors remain constant. Otherwise, we can't explain it, Puta. If there is no repayment of debt, means debt remain constant. Am I correct?
Yes.
Hello?
Sir.
Every year, day by day, the return earning will increase. We assume that remain constant, right? If there is no repayment of debt, means debt remain constant. Is that clear, Buddha? What do you want to tell them?
Yes, sir. Clear, sir.
Sir, can you please explain the meaning of moratorium? Is it like a negotiation?
No. Concessions given by the bank when you are in difficulties in repayment of loan.
Okay.
Which was given in 2019 after the bomb blast in Colombo.
Okay.
Right, no change in debt equity ratio, right? Or you can say debt remain constant, but interest payment will continue, and there is an impact on cost of debt. However, the cost of debt is at 4% in first 2 years, and thereafter it will come to the normal level. As per theory, when debt increase, value of the WACC will decrease. However, since company pay lower interest rate, in first 2 years, WACC will take comparatively higher value. Is that clear? Hello? Theory says when debt increase, WACC comes down, right? But here the rate is very low. This company is pay low interest rate. WACC will take comparatively lower value against third year and onwards. Hanifa,
Yes, sir.
is that clear?
Yes, sir. It's clear, sir.
You are thinking about what is theory, right?
No, it's fine, sir.
Varuni?
Yes, sir. It's theory with tax. Yeah. Consider.
Sriyanta?
Yeah, it's clear, sir.
Okay. I have to share this answer with you. Therefore, better I want to save this. Save carefully. Okay, then other question I just explained to you and I will share the answer with you today. Right, here is a ratio analysis. ELP is considering working capital and financial policies for the next year, estimated 5-year and current liabilities rupees 6 billion and 1 billion respectively. The management is considering investment in current asset for the next year carefully, as earning before interest and tax will depend on investment in current asset, mainly in inventories and debtors. Members of the board of directors have shown different risk appetite individually and has been challenging so far to argue on final decision on how much should be invested in current assets, right? Given below are the best estimate made at 3 basics level. Working capital policy, conservative, moderate, aggressive. EBIT, revenue, investments in current assets. Evaluate the following aspect under each working capital policy. Rate of return on total assets. Right? Net working capital position. Current asset to fixed asset ratio. Discuss the importance of supply chain finance and improving the working capital management of company, ELP. Now, rate of return on total asset. Earning before interest and tax is the total return on total assets. Therefore, EBIT should be divided by total asset. Is that clear, Varuni? You can take total asset
Yes.
from the balance sheet and divide each number. Varuni, is that clear?
Yes, sir.
Hanifa?
Yes, sir. In this case, we have to take the average average, no, everything.
No. Take separately 3 numbers and divide by total asset. These are 3 situations, right? In each situation, separately, you have to calculate. Is that clear?
Okay, sir.
Take the total asset and divide in each situation separately. Then net working capital position. Investment in current asset is this much in each case, right? That means you can take, we already calculated current working capital, how much is today. If you invested 1,500 further, what is the net working capital position? Then you have to consider the cash. Hanifa? In this case, you have to consider the cash, right?
Yes, sir.
Right. Then current
Okay.
asset to fixed
Yes,
asset ratio. Once you invested these current assets, your current asset will increase. Then current asset to fixed asset ratio, current asset divide by fixed asset. Take the fixed asset given in the balance sheet, add these additional investment to your current asset and calculate the ratio. I will share that answer by tomorrow. I will share everything by tomorrow. Then discuss the importance of supply chain finance in improving the working capital management of the company, ELP. Now, what I am not give more focus on this question. If I am want to help you, that previous question, project appraisal, that type of question can be tested in this week, right? Not this working capital matter, but remember your current given pre-scene given you a comparison of, some data of market. Hanifa, remember it. Hanifa?
Yes, sir.
The current pre-scene given, they have given some, remember they have given some, I will show you. This is an additional thing for you, right? Is that okay? Nobody is talking.
Okay, sir. It's okay.
Because
Yeah,
this
it's
is
okay,
the
sir.
important, this is the important point for your exam, not that question. In this pre-scene, I think you can see this is the current pre-scene given. Where is that Varun, that table given? Varuni?
So page number 12.
Well, this one. මෙන්න මේක නෙමෙයිනේ. ඔ මේක. මෙන්න මේක පුතේ for the market. හරිද? I will simply explain. This is for market. share කරන්න
It's
එපා නේ.
not shown.
ඒක share කරන්න එපානේ. ඒත් පිස්සුනේ නේ වරනේ. Right. Hanifa,
Yes, sir.
These all are industry data, right? I believe the examiner sometimes asks you to do a comparison of the given STL with these numbers. Actually, they have gave you how many customers you have. Therefore, you can put a column here and add how much STL has customers, right? Then you can calculate debt to equity ratio of STL. You can calculate debt to equity ratio of interest cover of STL. All these ratios you can easily calculate based on the given balance sheet. I think they will give you some comparison of STL numbers with these industry numbers. Better you get ready for this. Got it? Hanifa.
Yes, sir.
You are ready for this. Calculate and ready for the STL numbers, debt to equity ratio, interest cover ratio, net profit as a share of debt obligation, revenue growth and net profit growth. Everything you can calculate easily using the pre-scene. And they have given in some paragraph number of customers. They also have how much. Then you can see what is the percentage they have in the market. Find out the market percentage. I can remember it. Varuni, is that below 20%, 18%, right?
No, it's above 50%.
Above 50, no.
Yeah,
They don't have, this is the total
they
selling.
have more than 15 million.
15
Here
million.
total,
Right.
yeah. 20, 10, 15.
What I suggest you, put another column and do the STL calculation and make a comparison, Puta. Got it?
Yeah.
Ready for that?
Yes, sure.
Okay.
Thanks.
Right, now we can wind up. My battery also going to shut down. I believe you have learned something from me, right? I wish
Sir?
you all the best for this exam. Yes.
So if they have not given the discount factor as nominal or real, we have to assume it as a nominal discount factor, no, sir?
No, you have to calculate discount effect in this pre-scene. All the information available except KD. In this question, you have to calculate discount factor. You have to calculate the WACC. For your ECI, you have included WACC number here, but in exam, you have to calculate WACC. Because this is a listed company, market price per share, everything is available. Therefore, you have to calculate WACC. Clear, Varni?
Yes, sir.
Priyanka?
Yes, sir, clear.
Right, okay. Then I wish you all the best for all of you for the exam, right? And try to pass the exam this time. Don't wait for until December. නැත්තම් ඔයාලට ඉතින් මේ සබාදහම මොකද්ද කියනවා දෙසැම්බර්ම කරනවා කියලා. එහෙම try කරන්න එපා. Try to do it by this time. Okay? Thank you very much all of you for being with me. All the best and good night.
Thank you very much.
Thank you.